Good morning, good morning, good morning. How's everybody doing? Cash flow and profit, very important, right? We're not buying real estate to lose money. We want to know how much profit we're going to make. It's not worth the $20,000, right? But if we can buy it and then sell it the next day and make $20,000, that $20,000 is not that bad.
There's so many intricacies of a deal, so many different ways to work it and add value. The more you know, the more you can capture value on one end. Hey, Mr. and Miss Seller, we'll pay you double the value of the property, but you work with us up front and you can make a trade-off there.
And this is where the creativity, being able to think strategically, go into these negotiations, into these conversations, and use the entrepreneur method. Everything we talked about yesterday and everything we're going to do live today is really important. Welcome, welcome, welcome to the Monday Live, where we're talking buying deals, building wealth, and investing in real estate. Make it where I can share my screen too at some point. Welcome, everybody. Today, we're talking about building wealth through real estate and buying deals that will build wealth for you. Last time we didn't get to discuss the topic that we wanted to, so we are going to discuss it this time. We're going to be talking about 2024, what lies ahead, what the trends are, what you should be looking for, what we're investing in, what we're looking for, and how to prepare yourself and your family to start building wealth through real estate. So 2024, let's see where we're at. 2024, what do we have ahead of us? Well, the Fed says that there is going to be some rate decreases. Prime rate today is 8.5%. So rates are still high. Let's see here. Loan maturities and defaults are on the rise. Let's see. Today, we have people who are underwater who own some of these deals still. The NOI doesn't support debt. At the inflated prices. Go ahead and get on camera here. Doesn't support debt at inflated prices. And there is opportunity. So, 2024, it is a good time to be in real estate. We have not completely hit the bottom. And if you're holding some cash or you want to invest in some deals, now is a great time to do it. Into 2021, 2022, 2023, these were not great times to do it, but we have started to come down. Sellers have become a little bit more reasonable. The ones who need to sell and have to sell are becoming a little bit more from where they were last year. And right now, if you can buy good deals at good prices with debt, even at today's interest rates, and make it work, then you're setting yourself up and your investment up to do really well over the coming years. You know, like I said, the Fed is talking about decreasing the rate. They're talking about having rate decreases a few times this year. We don't know if that'll happen. Inflation numbers that came out this month and last month are remaining steady. There was a slight increase on a few sectors. So I don't think they'll be decreasing the Fed funds rate anytime soon, but they're saying that they will towards the end of the year. Prime rate today is still at 8.5%. Back in 2021, I believe the prime rate was near like 3.75%. Prime rate 2021. Let's see. See if I can find this information. It's pretty crazy. Yeah, prime rate in March of 22 was 3.5%. 2020, 3.25, 3.73. So prime rate has more than doubled in the last 3 years. Loan maturities and defaults, they are still on the rise. I want to share my screen here. Are you able to do the? Yeah, I will. Give me a sec. Let me exit out of some of this stuff. Only show what's relevant. And I'm going to show you guys today kind of where we're at, what you should be looking for, and where the deals are going to be found. Last time we were supposed to talk about trends, and I'm going to show you guys what the trends are. Let's get logged into CoStar here. 391581. All right, can you see this? How can you guys hear today? Where are you tuning in from? You from Austin? You from Texas, Florida? Now you can see. What can you see? Just curious. Just the screen or both of us? Both. All right. Okay, so I want you to comment where you're viewing from, because if you're in a place where maybe it's not good for investing, you need to look in other places, and it is possible for you to invest in different places all across the United States. But let's look here at let's look at for sale properties, multifamily. Minimum, let's say 32 units, maximum 100 units. Let's set these filters over here to loan. Maturity dates between today and, let's say, middle of 2026, June 1st. Let's see what we can find here. All right, so these are properties that are listed for sale. If we switch this back to not listed for sale, it's going to give us a full list of properties here that all have maturity dates between today and June 1st of 2026. And this is multifamily, 32 to 100 units. But let's look at a couple of the ones that are for sale. This one's in Longview, Texas. Let's see if we can figure out some information on this property. So I'm going to show you guys what I'm doing is I'm doing a little research, and I'm showing y'all where the opportunity is and why the opportunity is here. So they're not disclosing the price. Origination date 2015. All right, so this one is coming up. Man, this one's coming up for. They probably have room in here. How many units here? 63 units, Longview, Texas. It's for sale for $2 million. Looks like their current balance is about $1 million. So I don't have a feeling that these people are going to be experiencing any issues here. However, they have 4.8% fixed debt on it, and it's maturing in 2025. So the reason that this person has to sell is unless rates come down substantially to where they could refinance their principal balance around the same rate, it may not make sense for them to continue to hold this property if they had to get new debt at 7.5, 8.25% interest, almost double what they currently have. And as we can see here, their maturity date is January 1st, 2025. I want to find a different one though, where they might be experiencing a little bit more of the hot water. What's this one? Greenview Street. Let's look at this one. Built in 1986, trying to sell at a 6 cap, 3.5 million. Let's look at their loan. All right, so this is perfect. This is what we're looking for. The origination date is June 1st of 2022. They have a variable interest rate. So when they bought it, it was 4.75. Now, between June 1st of 2022 and today, their interest rate, depending on when it adjusts, their interest rate is going to be substantially higher. So if they bought this in 2022, which it's looking like they did, they probably paid too much for it. I'd like to see what they bought it for. Prior sales, it's not available. Anyways, this person probably bought this property June 1st of 2022. They got a variable interest rate loan on it at 4.75%. It's probably a good property. And in Albertville, Alabama. But they have variable rate debt on it. It's not interest only. They're paying principal and interest. And since they bought this property, their debt cost has increased substantially, I would assume. If their origination balance is 2,174, let's see here. So they're trying to sell it for 3.5 million, I believe. They probably bought it for around 3.1 to 3.5 million. If their debt today is, let's just say it's 7.5 to 8%, 2,174 times their debt on this property is probably around $200,000 a year, which is substantially more than it was when they bought the property. So that is what is causing them to want to sell this property. Their debt probably almost doubled what they're originally paying. Their maturity date, why is it saying, why did this, oh, it's for sale, but the maturity date isn't for a while from now, 2042. But since they bought it in 2022, the cost of debt has increased substantially. So if they only owe 2.174, in order for someone to buy it today, yeah, right, 200 grand. When they bought it, it was 100 grand. Their debt has doubled. So in order for them to sell it today, they're probably going to have to sell it at a price that they don't want to sell at. And if you're able to buy it at a price today and make it work with today's interest rate, then when rates are lower, the value of the property will increase, your cash flow will increase, and you should be able to refinance out of it into longer term debt at a much better rate. Look at this one in North Carolina, 80 units for sale. All right. They bought it in April of 2020 for 4.5 million, $56,000 a door. It's going to move around too much, but come move it wherever you want. I mean, it's just going to make noise. It's going to be rubbing up against my thing. I'm going to leave it there. Anyways, this is what you're looking for here. And these are the types of opportunities that I didn't even move it. These are the types of opportunities that are available right now. Multifamily, we're looking at, let's see here, retail, flex, some industrial, property size, minimum 10,000 square feet, 35,000 square feet. Look at all these properties with debt that is maturing in the next 2 years. These are the opportunities that are existing. This is what you should be looking for. And this is what the last 3 years has created. 2020, 2021, it was so easy to make money in real estate that people were overpaying for deals. Everybody was a real estate investor, and they overpaid for properties. They got too risky. They raised capital from investors to take these deals down, and they got debt with risky terms. I'm going to hop off the screen share. And when they did that, yeah, there you go. Leave it there, though. And when they did that, what happened is they weren't anticipating rates jumping up as high and as fast as they did, and remaining at the rate that they're at for so long, because otherwise they wouldn't have taken that risk. So with all that, when we're talking about trends, here is the trends that you should be following and looking for in 2024. First and foremost is buying below value. Look for value. You want to look for something that you can increase the value on. Maybe it's being poorly managed. Maybe there's the ability for you to raise the rents as far, under market rents. With our RV park that we're buying, for example, what we're doing is we're going to go in there. We're going to add a little bit of value to the property to increase the resident experience. And within the first 3 months, as we're executing that part of the business plan, phase one, we're going to start raising rents up to where they need to be at $625, $650 a month, which is about a 20% increase from where they're currently at. And the moment that we do that, we're going to add about $2 million worth of value to the property as we execute phase one and start raising rents. So that is buying below value. Even though the property as is today is doing well, and it's brand new, it's not like we have to renovate a whole bunch of units and add a bunch of stuff to the property. It's all just concrete for the most part. We are buying below value because we're going to come in, execute our business plan, and increase the value of the property substantially. This is where it's been the whole time. It's just going to move around, but all right. So this is us buying below value. We're looking for value. On the retail strip center that we just bought in Florida, we raised the NOI on that we're raising the NOI on it by about 30-40% within the first 12 months by simply just renewing the leases with the tenants, getting new tenants in there, and increasing the rent and passing back expenses. So that's what you're looking for. Buying below value. We also bought it, a few $100,000 below what it appraised for the day that we bought it. We bought it for 1.45. It appraised for 1.7. So slightly below, but the real value creation comes when we increase the NOI. Second thing you're looking for as a trend in 2024 is cash flow. Do not buy the property if you're holding on to it. Do not buy the property if it's not going to produce cash flow. In both of those examples that I just mentioned, the strip center and the RV park, they both cash flow day one. Even if we do absolutely nothing to it, the property's cash flow, they produce a return, but we're not after the return that they're currently producing. We're after a much greater return that we're going to generate by executing our business plan. However, they do both cash flow day one. If they didn't cash flow day one, let's put that there. It's important. It would be, and they would be substantially less attractive to us because we know in the worst case scenario, even if things remain as is with the properties, they're still going to cash flow and they're still going to provide a good return to us. Second thing is we're in a new debt market. Buy deals that support debt. Here's the thing. If they support debt in today's debt market and in today's economy and climate, then they're also going to support debt when interest rates start lowering. Not only will the property support debt when interest rates lower and you refinance into better debt terms, but the value of your property is also going to increase substantially. Cap rates are higher right now due to debt being higher. When debt lowers, cap rates are also going to lower, and that is going to create value for your property. Second thing is making sure. Fourth thing is having the ability to add value. Now, when I talk about adding value, it doesn't necessarily mean that you're going to go in and, the property is 30% occupied and you're going to go in and renovate a whole bunch of units. And there was a 200 plus apartment complex we were looking at near the coast of Texas, and it needed a ton of work. Like 30, 40 units were fire and water damaged. It was like 70 or 60% occupied. There's a ton of things that needed to be done to that property. And traditionally, I think that that's what people associate with value add, is going in there, adding value to the property by renovating the units, doing a whole bunch of work. But that's not necessarily what I'm referring to here. What I'm referring to with having the ability to add value could simply mean just raising the rents without doing anything to the property. It could mean getting better management in there. It could mean passing back triple net expenses to the tenants that weren't currently being charged. It could mean, new signage, any of those types of things that don't require a ton of money, time, labor, etc. It is also adding value. So you don't want to buy something that's currently maxed out with its value creation, right? Because you're limiting your upside. You want to find opportunities that somebody else is missing or is too lazy to do. That way you can go in there, seize that opportunity, and increase the NOI and the income of the property, therefore increasing the value of the property. And let me show you guys what I'm talking about here. Let's say that we're going to keep the topic of trends. You'll see how I'm calling these trends, but they're really just real estate basics. And that's kind of the whole point, is don't get lost in the trends. Don't get lost in, everybody who bought Airbnb properties, everybody and their cousin wanted to own Airbnbs in 2020, 2021. And a lot of those people I don't think are doing too well right now. I'm sure some are, but most probably are not. So don't focus on these trends. Don't listen to what if people who are not in real estate are talking about getting into real estate and following a trend. It probably is an indication that you should stay away from it and really just stick to the basics of owning good real estate, and you'll never go wrong. If you follow the basics, you follow these rules, you stick to the rules, and you make sure all the deals meet these criteria, then you're going to build wealth. You're going to get cash flow. You're not going to buy bad deals. You're always going to have upside. You're always going to have an exit. And while you're gaining all this wealth and income by buying good deals, you're also going to be able to take advantage of all the tax advantages that real estate has to provide, limiting the taxes that you pay to the I and the R and the S. All right, so I just want to show y'all. Let's say you find a 50-unit apartment complex, and let's say you found one of these sellers who has their debt maturing, and you're just going to buy this property at a great price. They're unable to sell it at the 4 cap that they bought it for. And let's say that this traditionally trades at a, I don't know, 5, 6 cap market. Let's call it a 6. And let's say you were going to buy it at an 8 cap due to today's interest rates and needing to be able to get debt on it. So this 50-unit apartment complex, let's say that it rents out for $1,250 a month, which is below market rent. I need to take these notes. $1,250, 6 cap market. You're buying at an 8 cap. I'm going to show y'all how you can go out there, take these properties, and set yourself up for the future. Divided by 0.4 times 0.55. All right, let's say your NOI on this deal, with them being rented out at $1,250, 90% occupied, your NOI is $370,000. All right, now you're going to buy this thing at an 8 cap divided by 0.08 because you need to be able to get debt on it. So that means your purchase price is going to be $4.6 million. All right, you're going to get debt on it. You're going to get debt at 65%. So your debt's going to be about $3 million. I'm rounding some of these numbers for simple math. Your debt's going to be $3 million. That's going to cost you let's just say it's going to cost you about annual payments. It's going to cost you about $232,000 a year. Your NOI is 370. So 370 minus 232. So your cash flow is going to be about $138,000 a year, which is probably about a 138 divided by, it's about 8.6% cash on cash return. So the deal pencils, the deal makes sense. You're buying with today's debt. You have the ability to raise these rents to $1,500, and that's going to be your business plan. Is over the next 12 months, you're going to power wash the property. You may do some things around the property to make the experience a little nicer. You're going to get better management in there. You're going to start executing your business plan after you buy this thing. And in 2027, Kat, what are rates going to be in 2027? Let's say, high. Let's say your rate is going to drop from a 7.75 down to a 5% rate over the next 3 years. Possible, I believe. And when you do that, the market is going to go back to the 6 cap. So over the next few years, you're raising rents to $1,500 a month. You're going to still have your 50 units, 12 times 0.55, 45% OPEX percentage, your NOI is now $445,000. The value of the property, because this is our new NOI, and this is what the property is valued off of, and the rates have lowered, and the market is now trading at a 6 cap. Your new value of the property, oh my God, that's wild, $7.4 million. So what is the difference here? It's almost a $3 million difference that you just capitalized on with the property. And let's say you refinance out of it. Let's call it the $7.4 million value. 0.65. Oops. 7.4 million. 0.65. Your new loan balance is going to be 4.8 million. So you're going to get all of your money back plus an extra 200 grand. You're going to pay off the old debt, 4.8 million, and your new debt payments at 5% interest. Wow, this is crazy, right? Annual payments are going to be 240 grand. So your debt is only going to increase. Your annual debt payments are only going to increase by about $8,000 a year. Now your cash flow, it is $200,000 a year in pure free cash flow. You have no money in the property, and you created $3 million worth of value simply by raising the rents and executing your business plan. And there's that delta there because you're not paying the 6 cap that the market typically trades at when rates are lower. You're paying the 8 cap. You're buying into value. You're following these rules, these trends that I was just talking about. Buying below value, cash flow day one, buy deals that support debt in today's market, and having the ability to add value. In this case, that was raising the rents from $1,250 to $1,500 a month. And these are the types of deals that you're looking for. You don't want to go out and overpay for something today that doesn't have the ability for you to add value to it. You don't want to pay a price that nobody else is paying and overpay for the property. You don't want to, number one, you're not going to be able to, but you don't want to go out and buy something that's going to be negative cash flow. You want to be very conservative in your underwriting and in your negotiations. Right now, more than ever, is the best time to be aggressive. We've never had the ability to be as aggressive as we are now with purchasing our deals because the market was crazy and people were losing their minds and paying whatever prices they wanted. And now since that's happened, they're losing the properties. I can think of a few instances here in Austin where operators who did this in 21, 2022, 2020, they overpaid for properties, they got debt they shouldn't have, and now they're in really hot water. And they can no longer afford to own these properties, and the banks are either going to take them back or these operators are going to have to go out and raise more capital, $200,000, $300,000, $500,000 to pay the lenders to extend the terms and keep the debt cost down. And when they do that, they're just diluting. They're not getting a return anyways right now, but they're diluting any return that would have been there for the investors, for the property, and they're just trying to hang on for dear life. And so you don't want to put yourself in those situations. You need to stick to the basics. You need to stick to the trends that always work within real estate. Follow these rules. You need to focus on good locations. Who knows anything about Hondo, Texas? I was just talking to somebody about a deal in Hondo, Texas, and they wanted a population of like 8,000 people are there. I don't even know where that's at. You ever heard of Hondo, Texas? Let's see where Hondo, Texas is at. I feel like it's outside of San Antonio. Hondo, Texas. Yeah, it's west of San Antonio. Anyways, they got like I think it's like a 10 to 14 unit apartment in Hondo, Texas, and they're wanting us to pay, kind of a ridiculous price for it. NOI is like 60 grand. They want to sell it for $1 million, and it's just not that attractive. It doesn't meet any of those things that I just mentioned, and it's not in a great location. Um, we want to buy good deals that can provide those things that we're mentioning. And these are the types of deals that are going to produce substantial returns for us, for the LPs, for our investors, for our partners. We want to only focus on those, and that's what you should be focusing on as well. Don't get caught up in the trends. Don't listen to what your neighbor's doing. If a lot of people are doing it, it's probably not going to last very long. And stick to the basics. A lot of people I've heard, kind of. I mean, the return that you would get on that example that I just mentioned is way better than any Airbnb return that you would get. The Airbnb is cyclical. If Airbnb cuts it off, or if the city cut off short-term rentals, you're screwed. You're likely going to be overpaying for the property. If Airbnb didn't work and you had to rent it out to a long-term tenant, it's not going to work and you're going to lose money. There's so many things that could go wrong. And even if it did go right, if you put your money into a deal like the one that we just went through, you'll be good no matter what the cycle is. You'll always have demand for your product. There's always going to be people that need $1,500 rents in a good market. And there's always going to be someone who wants to buy that from you. Nobody's going to want to buy your $2 million Airbnb house when it's not doing well and you're trying to sell it and get out of it. So don't follow the trends. Stick to real estate basics. Buy good deals in good locations with cash flow that you're buying below value, that you can add value to, that support debt. That way, you will always do well. You'll never be underwater, and you'll always have a buyer for it. And if you just do this over and over and over and over again, the BRRRR strategy, like I just mentioned, where you add that value over a few years, refinance out, pull all your money out of the deal, and go use that same capital. It's a non-taxable event. You're not going to pay taxes on the refinance. Take that money and go use it for another deal and just continue to do that. You'll I don't know what you're worth right now, but you'll be worth over $10 million in no time. If you just do 5 to 10 of those deals, you'd be worth 10 to 20 million. And quit your job, have financial security. You're not going to be paying many taxes on it if you utilize depreciation in the right way. And you're going to be a real estate professional that has great assets, good locations that will always provide for you and your family. If you want to learn more about what we got going on, go to TREcommunity.com/TR3. Reach out to us. We have a few projects that we're working on. We want to partner with you. If you have any deals that you need help looking at, reach out to us and our team. We want to do more deals with you. And we're excited for what 2024 has to hold. Like I said, last year was really tough year. Last year we didn't buy a whole lot. We were super aggressive. But the problem with last year is sellers didn't want to sell either. So there were people who wanted to sell, but the motivation wasn't quite high enough in order for them to sell at the prices that they needed to. But after 12 months of going through that, those who need to sell are selling, and deals are here. So make sure you don't miss it because it's not going to be here for long. And we'll see you next week.